of a business, hopefully, how to enhance the value of a business. Note that I said value enhancement, not price enhancement. Two very different concepts. In value enhancement, everything you do has to flow through one of the four ingredients. You either have to find a way to increase cash flows from existing assets, or you have to push up the growth rate that you see in the future, or you have to reduce the risk and the discount rate you apply to those cash flows, or you have to push off the day of closure where your company becomes a stable going concern or you liquidate the business. Everything you see in restructuring and value enhancement has to go through one of those four pathways. And in this session, I hope to lay out those pathways. Now that we have all the ingredients to value a company, the cash flows, the growth rates, the discount rates, and the closure factor, the terminal value, we can value any company, right? I want to talk a little bit now about how to change the value of a company. Because if you run a company, the question you're often faced with is, how do I increase the value of the company, not just maintain the value? So I want to talk about value enhancement. Before I get started, though, I also have to note that when many companies talk about value enhancement, what they're talking instead about is price enhancement. And that's a very different thing. To illustrate the difference, I'd like to show you two graphs. These two graphs both look at companies that changed their names. They're separated by about 4 years. The first study happened in the late 90s, and it looked at companies that added .com to their names. This was the peak of the .com boom. And not surprisingly, when they looked at these companies that added .com to their names and changed nothing about their businesses, they saw the prices jump by a lot, 100%, 150%. Now remember, if they're not changing anything about their businesses, their intrinsic value shouldn't have changed. But their price did jump. You're saying, this is good. Why waste your time on cash flows and growth rates and discount rates when all you have to do is change your name? But what the market gives, it takes away. The second study also looked at companies that changed their names, but this was in 2002 after the .com bust. And these companies removed .com from their names. The market reacted positively. What I'm trying to say is, if you try to make your job increasing prices or enhancing prices, you're going to be dancing to a tune that the market calls, and that tune might not be the best one for your company. So rather than focus on things you can do to increase prices, I'd like to talk about how to enhance value. And here are the four ways you can increase value. And they go back to the four pillars that we used to talk about valuation. To increase the value of a company, you can try to increase the cash flows from existing assets. Run them more efficiently. To increase value, you can try to increase your growth rate or enhance the value you get from growth, either by becoming more efficient about running your existing assets, or maybe finding a better combination of reinvestment to deliver more value from your growth. The reason I say more value from your growth rather than higher growth is some companies might actually be worth more growing at a lower rate rather than a higher rate if their growth is not good, if it's destroying value. Third, you can try to lower your discount rate. The obvious way might be to change the mix of debt and equity, but there might be others. And the fourth and final way is you might put off that day of reckoning when you become a mature company, a stable company. How are you going to do this? If you can build up your competitive advantages and barriers to entry, maybe you will not become a stable growth company for 10 years rather than 5. So increase your cash flows, try to get more value from growth, lower your cost of capital, push off the day of reckoning. So I'm going to talk about how to change value using those four basic approaches. Let's start with the first one. How to increase cash flows from existing assets. Let me break down how we measure cash flows. We start with operating income. We net out taxes. Then we net out reinvestment, right? If that is the case, here are the places you can go to increase your cash flows from existing assets. You can run your assets more efficiently. You can cut costs that are really not creating any value. What I hear when you say that is higher margins, higher operating income on the same revenues. That's going to increase your value. If you can pay less in taxes on that operating income, and I don't mean to sound unpatriotic when I do this, but I don't think any company should view it as its objective to maximize taxes paid. So to the degree that the law allows you, if you can minimize taxes paid, you pay less taxes on the same operating income, you increase your cash flows, and you increase value. And if you can reinvest less to maintain your existing assets, you can increase value. So basically, you're looking for places in your you increase value. And if you can reinvest less to maintain your existing assets, you can increase value. So basically, you're looking for places in your existing cash flow where you can get more cash flows and higher value. If you're coming into a firm which is an old, mature firm, this might be the place to look for higher value. Is can you cut costs? Can you increase cash flows from existing assets? Second stop on the road, look at your growth rate. As we've structured growth, to grow faster, you either have to reinvest more or reinvest better. Reinvesting more will tend to increase your growth rate almost always, but reinvesting more might not always increase your value. Because here's the qualifier. Reinvesting more creates value only if the return on capital you earn is higher than the cost of capital. So let's step back. Here are the two ways you can reinvest more. You can try to find more projects internally, but that's going to take you a long time, or you can do a big acquisition. You can always buy growth, but if you pay too much for that growth, it's not going to increase your value as a company. You can try to improve your return on capital in existing investments, and I like to think of return on capital as broken down into two components. There's your operating margin, and the second is how efficiently you deploy your capital, your sales to capital ratio. So if you can increase how much revenues you get for every dollar of capital you've invested or improve your margins, it shows up as a higher return on capital. I would argue that almost everything we talk about in business, even if it's pure marketing, will show up in one of these numbers and will ultimately show up in value. Now, when we talk about growth, we tend to think of different ways companies can grow, and we often make the mistake of treating them all as equivalent. But there's some very interesting research that's emerged over time that looks at which growth approaches are most likely to create value and which ones are most likely to fall short. This is from a McKinsey study that I saw a few years ago, which looked at companies that had adopted different growth strategies over time and then asked a follow-up question. How much value was created by each growth strategy? Ranked from best to worst. By far the best strategy McKinsey found across companies was a strategy of coming up with new products. Think of Apple in the last decade. The iPod, the iPhone, the iPad created tremendous amounts of value, new products that break through into new markets. Why doesn't every company try it? They do, but only a few succeed. And if you do succeed, there's no better strategy. The second best strategy is to find new markets geographically or new markets within the same geography to do different things. Aspirin, headache medicine, right? Until it became something that could be used to treat heart disease. So expanding into new markets, expanding a market, second best strategy. Fighting for a market share in a growing market, not a bad strategy, because even if your market share stays constant, if the market itself is growing, you can still be profitable. And then you get to the two strategies that historically have been more likely to be losers than winners. If you fight for market share in a stable market, the only way to get a higher market share is often by cutting prices. It might not be value enhancing. You might get more growth, but the lower margins that growth comes with will deliver lower value. The worst strategy of all historically has been a strategy of growing through acquisitions. I don't mean to be cynical, but if you grow by acquiring other companies, especially if they're large publicly traded companies, the only way you can win is by paying a premium over the market price. That ups the ante. It's much more difficult to win with an acquisition-driven strategy. I'm not saying it's impossible, but it's much more difficult. So when you think of growth strategies for a company, look for the one that is not just likely to deliver the most growth, but the one that's also likely to deliver the most value. The two might not always be the same. Which brings me to the third way in which you can increase value. Maybe you can push for a longer growth period. The abstraction, that's a number that you use in valuation, but it reflects your competitive advantages. So what I'm talking about here is either coming up with new competitive advantages if you don't have any, or if you do have a competitive advantage, sustaining and augmenting that competitive advantage. I'm not a corporate strategist, but I can think of at least 4 potential competitive advantages that you could be building on. The first is a brand name. There's no better competitive advantage in history because nobody quite knows how you create a great brand name. But if you have one, take care of it. It might account for 60, 70, 80% of your value, and it's a very difficult competitive advantage to overcome. The second is legal barriers to entry. If you're a pharmaceutical company and you have a patent, you're protected from competition. So look towards some degree of competition, perhaps your lawyers can help you. If the government offers you protection from competition, be careful, because there's always a quid pro quo. In return for that protection against competition, you might have to give up pricing power. But if you can get protection against competition, go for it. The third is switching costs. What am I talking about? You want to make the cost of switching into your product as low as possible, and you want to make the cost of switching out as high as possible. If you can do that, you've created a significant competitive advantage. And the fourth and final potential competitive advantage is if you have a cost advantage over your competition. It costs you less to produce a product. You can build on that, right? Either by charging a lower price than everybody else and selling more, or charging the same price as everybody else and delivering a higher margin. So when I hear strategists talk, that's basically what I'm looking for. Are there things this company can do that can push out their growth period and increase their value? So that brings me to the fourth and final way you can increase your value, which is to reduce your cost of capital. When you talk about it, the most obvious measure that people use to reduce the cost of capital is to change the mix of debt and equity. And that works. If you're a company that's 95% equity, maybe by going to 75% equity, 25% debt, you could have a lower cost of capital. The reason, of course, lies in the tax code that seems to be tilted towards debt. But there are other ways you can lower your cost of capital. And here are the three other ways. One is you can try to make your product or service less discretionary to your customers. In other words, make it more of a necessity. I don't know how you're going to pull that off, but if you can, that reduces your cost of capital. The second is you have a lot of fixed costs as a company. Try to bring them down. Fixed costs make you a more risky business. They increase your cost of capital. I can think of at least two ways you can bring your fixed costs down. One is outsourcing, where you take a fixed cost and make it a variable cost. The other is you try to form more flexible wage contracts with your employees. That again makes your cost structure more flexible and it lowers your cost of capital. There's one final thing you can try. If you mismatched your debt to your assets, you've used short-term debt to fund long-term assets.
Okay, so this formula is the WACC. Okay, so here the cost of capital. So it's a weighted average cost of the capital by cost of equity multiply the cost of equity by the ratio E over D plus E plus the pre-tax the cost of debt time the D over the D plus E. Okay.
Dollar debt to fund euro assets. Get rid of that mismatch. It increases your default risk and increases your cost of capital. And getting rid of the mismatch will lower your cost of capital. So here's what I do. If you gave me a company and said, how would I increase the value in this company? I'd have to take a look at the company. I'd have to look at the places I'd go to try to increase value. So let me try one simple example. It's a valuation of SAP I did a long time ago. Value that I got per share was 106 euros. But if you look at the top of the page, it says SAP status quo. So what does that mean? I valued SAP with its existing management in place. The existing management in 2005 was a pretty good management, but they had two blind spots. One is they hated borrowing money, and that shows up in their debt ratio. It's 1% debt, 99% equity. The second was they were a little wary about investing in emerging markets. So even though their reinvestment rate is healthy, 57%, it's not that high given their opportunities in emerging markets. So this value reflects the company as is, run as is. So let's assume that you came in. You're the new CEO of SAP. What could you do differently? Well, the first thing you could try is try for more debt, right? But you can't just increase the debt ratio to some number without knowing what consequences it'll have. So to help you in that process, here's what I've tried. I have actually estimated the cost of capital for SAP at different debt ratios, from 0% all the way up to 90%. It sounds fancy, but here's all I do. As the debt ratio goes up, I re-estimate your cost of equity. And not surprisingly, as you borrow more money, your equity gets riskier, your cost of equity goes up. As you borrow more money, I also estimate how much it'll cost you to borrow money. That'll go up as well. But the weighted average of those two numbers actually goes down, at least initially. In fact, as the debt ratio goes from 0% to 10 to 20, all the way up to 30, notice the cost of capital keeps dropping. Beyond 30%, that starts to hurt you. Your cost of capital goes up. If you ask me what the optimal mix of debt and equity is for SAP, I'd say 30%. So here are the two changes I made at SAP and revalued them. I increased the debt ratio, saying they should be a little more aggressive about borrowing money that lowers their cost of capital. I also assumed a higher reinvestment rate, that they could reinvest more in emerging markets, and that pushes up their growth. It's magic. With those two changes put in, the value per share that I get is 126 euros. Obviously, this is a lot easier to do on a spreadsheet than in practice, but with real businesses, that is often the challenge you face. How do you change the value of the company? How do you make those changes on the ground? And how do those numbers ultimately show up in your value and price? Summing up then, if you have to enhance value, start with the basics. And the basics ultimately are, to change value, you've got to increase cash flows. You have to find a way to get more value from growth, to reduce your cost of capital, or you have to push out that stable growth period. They're all doable. None of them is easy, but enhancing value doesn't happen in a corporate finance boardroom. It happens on the shop floor. It happens in the marketing department. Value enhancement is everybody's responsibility.
小轩，我跟你说哦，我昨天又跟阿明吵架了。啊？
So let's say you've estimated the cash flows for a business. You put closure on those cash flows, you've attached a discount rate, and you value the business. You think you're pretty much done, right? Well, wrong. In this session, I hope to talk about how you get from that number to the value of the equity in the business, which is the number you might care about if you're an investor. To get from the value of a business that you get by estimating the cash flows and discounting them to the value of equity, there are 4 additional steps you need to take. First, you have to decide what you're going to do about the cash you have on your balance sheet. It should be simple, right? Just add the numbers on. But that's not always the case. Second, if you're a company with cross holdings in other businesses, you own 5% of company A or 10% of company B, you got to bring those ingredients into your value. Third step, if you have any other assets that have value that you haven't counted yet, this is your last chance to count them. And the last step in the process is if you owe money. If you have debt outstanding, you got to subtract out debt. In this session, I hope to look at each of those 4 pieces and talk about how best to estimate them. So now we have the tools to value just about any business, right? We estimate the cash flows. We come up with a discount rate reflecting the risk in those cash flows. We attach a growth rate, and then we put closure with the terminal value. We discount the cash flows back. We should be done. Well, not quite. Because in a sense, there are a few loose ends to think about before you come up with the value of equity in this company. Because you value the business, you need to get to the value of equity. And there are 4 adjustments I'd like to talk about in this session. I want to first start talking about what to do about cash and marketable securities that almost every company has on its balance sheet. How much can it be? Well, in the case of companies like Apple, it could be $100 billion. So it's not penny change. What do we do about cash and marketable securities? Second, I want to talk about cross holdings in other companies, minority holdings, 5%, 6%, 8%, 10%, and majority holdings. What if you own 60% of another company? Third, I want to talk about other assets that you might not have counted yet. This is your last chance to sweep them into your valuation. And finally, I want to talk about what debt I should be subtracting out to get to value of equity. So cash, cross holdings, other assets, and debt. Let's start with cash. To understand how cash affects valuation, let me take a very simple case of 3 companies that look exactly the same in terms of the value of the business you've come up with. So these are values you got by discounting cash flows at the cost of capital. They all have billion-dollar values. They all have exactly the same cash balances, $100 million. So there's no doubt about how much cash they have. But here's where the 3 companies differ. The first company has a return on capital, historically, almost exactly equal to its cost of capital. And it's a developed market company. The second company, historically, has had a return on capital of 5%, well below its cost of capital, and it's also a developed market company. The third company is a company that has generated well above its cost of capital, and it's an emerging market company. All three companies have 100 million, right? Now, I actually think that when you value these companies, in one of these companies, cash is a neutral asset. In other words, 100 million in cash is worth 100 million. In one of these companies, cash is going to be discounted by investors. It's going to be valued less than 100 million. And in the third company, cash might actually trade at a premium. Step back. Think about it. Of these three companies, in which company is cash most likely to be a neutral asset? I think it's going to be company A, and here's why. Company A is what I call a blah company. What's a blah company? It does no good, it does no bad, it pretty much runs in place. Not a great company to invest in, but not a bad company either. There you're saying cash doesn't hurt me, it doesn't help me. Cash is worth exactly what I see. That's good. That's our conventional practice. Company where I'm most likely to discount the cash, I think company B, and here's why. It has a bad track record, right? It's not the cash itself that worries you. It's what the managers of this company will do with the cash. I call it a stupidity discount. There are some managers I don't trust with my cash for good reason. And here's the way I'm going to deal with it. If they accumulate cash, I'm going to discount the cash, not because the cash by itself is a bad asset, because I'm convinced these managers will find a way to waste that cash. And in the emerging market company, I might actually attach a premium for two reasons. One is the company does pretty well with my cash, right? Historically, it's earned a pretty good return on capital. The other is, in an emerging market, capital markets often shut down. And if they shut down, having that cash might allow this company not only to survive the downturn, but actually use it as a strategic weapon to buy assets for less than what they're worth. So what I'm trying to say is, if you're asked, is cash good or bad? The answer is, it depends. It depends on the company. To show you that I'm not being outlandish in these assumptions, let me show you the results of a study that was done about a decade ago. This looked at the value of cash in the hands of US companies, at least as the market saw it. So what it did was, it looked at thousands of US companies, and it looked at how much the market valued a dollar in cash in the hands of these companies. First, the good news. Across all US companies, a dollar in cash is valued at roughly a dollar. That's good news because that's what we tend to do in valuation, is take the cash balance and add it on. But here's the bad news. When this study looked at mature companies that earned below their cost of capital, companies like Company B, a dollar in cash was valued at 69 cents. Think about it. You have a mature company with a bad track record that has $10 billion of cash. The market is going to discount that cash 31% and value it at $6.9 billion. If you were giving value enhancement advice to this company, it'd be very simple, right? Give the cash back. They'll come up with 100 excuses why they shouldn't, but it's good advice nevertheless. And when they looked at young growth companies, so these are companies that face capital constraints probably, a dollar in cash is valued at $1.22. So just because a company has a big cash balance doesn't mean its value will go up when the cash is returned. It really depends on the company. Second stop in the process, cross-holdings. Cross-holdings are what I call the black hole of valuation. It's the thing I most detest in valuation, is valuing companies with lots of cross-holdings. And here's why. The accounting for cross-holdings is all over the place. At least in US accounting, there are three ways a cross-holding can be accounted for. If you own a small piece of a company, 3%, 5%, and take absolutely no role in how that company is run, the holding can be classified as a minority passive investment. If you have a minority passive investment, here's what you have to show on your income statement, the dividends you receive from those cross-holdings. And here's what you have to show on your balance sheet, what you originally invested to get that cross-holding. Think about it. If you invest in a young growth company 10 years ago, let's say 20 million, that young growth company is now worth a lot, $100 billion. In your income statement, I might see nothing because that company still doesn't pay a dividend. And in your balance sheet, I might see the $20 million you invested 10 years ago. That doesn't help me very much. That's minority passive investments. Here's the second step up the ladder. Let's say you own 5, 10, 15% of a company, take some role in how the company is run. Then you have to use what's called the equity approach. What's the equity approach? In your income statement, you have to show 15, 20% of the net income or net loss of that company, but below the operating income line. And in your balance sheet, you have to update your original investment for the portion of retained earnings you've accumulated since. So in other words, it's like an updated book value. A little better than minority passive investment, but not quite there. And if you own 55, 60% of a company, you're required in most accounting standards to consolidate, which effectively means you got to act like you own 100% of the company. All the way through. In your income statement, you have to show 100% of revenues and 100% of operating income. In the balance sheet, you have to record 100% of the subsidiary's assets. But here's how you show the fact that you don't own 40 or 45% of the company. The item that shows up is minority interest. It shows up on the liability side of the balance sheet. It reflects what the accountant thinks the 45% that doesn't belong to the subsidiary is worth. It's a book value. Now you see why it's so difficult to value cross holdings. First step is you got to figure out how the accountants have dealt with these cross holdings. In a perfect world, here's how I'd value cross holdings. I'd value the parent company standing alone. Then I'd value each cross holding separately. I don't care whether you own 5%, 10%, or 65%. And I take the percentage of each subsidiary that belongs to you. The advantage of doing it is I can have different characteristics for each company. Different cost of capital, different growth rates, different risk profiles, which I think is appropriate. So in a perfect world, this is how I'd value companies. But in this world, I'd need full financial statements for every subsidiary and have a parent company financial separated from the consolidated financial. In the world that we live in, that's often not the case. We're not given the information on subsidiaries to do this full-fledged valuation. We're given pieces and bits. And especially if the subsidiary is a private business, you might have very little to go on. So here are two options you might use to at least get an approximation. If you have a cross-holding in a publicly traded company, you can always cheat and use the market value of that holding. It's cheating because in intrinsic valuation, we are assuming the market makes mistakes. But this might be your best choice if you have no other information. If your holding is in a private business and you have the book value of the holding, you can apply a price to book ratio. Based on what? Based on what publicly traded companies in that business trade at. So if I have cross-holding in a chemical company, and it's a private company, and a typical chemical company trades at 1.5 times book value, I might multiply the book value by 1.5 to get my estimated value for the cross-holding. I'm not happy with doing that. I'd rather do an intrinsic valuation, but without the information, this might be the best you can do. So you've dealt with cash, you've dealt with cross-holdings. Third step in the process, look around. Are there any other assets you want to bring into the mix? And let me separate the assets you should try to bring in from the assets you should not. You don't want to double count assets. Any asset that is generating cash flows should not be counted. So if you have a factory that has a physical value, a real estate value, you should not be adding the factory to the present value of the cash flows you get from operating the factory. If you have a headquarters building, you shouldn't be adding the value of the real estate in that headquarters building to the value of your cash flows. That'd be double counting. So what you're looking for are truly unutilized assets that have value, but you haven't counted in your cash flows. Those are rare, but they can exist. You might even decide to count things like overfunded pension obligations. Overfunded in what sense? You have more assets than you owe. It's a little tricky because you might not be able to claim that overfunding, but you're basically mopping up. So when you mop it, just make sure you don't double count assets, but it's okay to count assets you haven't counted yet in the cash flows. Last step in the process, you're trying to decide what to subtract out, what debt to subtract out to get to equity. Subtract out all the interest-bearing debt and lease commitments you treated as debt to come up with cost of capital. So that's the easy one. But this is also your last chance to mop up for anything else that might trouble you. So if you have a tobacco company as your investment, what might worry you? You might be the target of lawsuits, and you might have to worry about, what if I lose those lawsuits? You have to take the expected value of those lawsuit losses and subtract them from the value of your equity. Not easy to do, but I don't see a way around it. So this is your last chance to deal with anything else that might concern you. Use the chance. So in summary, after you've discounted the cash flows back at the cost of capital to get to the value of the operating assets, mop up. Add the cash and marketable securities. Value the cross holdings the best you can. And if you have a company that has minority holdings or majority holdings, see if you can value them correctly. If not, use one of the approximations I suggested. Add any other assets you haven't counted yet. Don't double count. And subtract out debt, and in this case, define debt expansively. not narrowly as we did with the cost of capital. You should have the value of equity in your business.
在盲目的追高杀低吗？你还在听人报名牌吗？您还在花大把的。
So let's say you valued a business. You've added cash, you've added cross holdings, you've taken any other assets that are out there into account, and you've subtracted out debt. You have a value of equity for an ongoing business. In this session, I want to talk about 3 additional components that might show up in your valuation, not always, but sometimes. The first is synergy. Usually you hear this word in the context of acquisitions, where 2 companies come together and they're able to do something that they could not have done as individual companies. Does that have value? It could. And we'll talk about how best to value that item. Second is control. Again, it often shows up in the context of acquisitions. Many companies pay a control premium. They'll add 20, 25% of the value of a business to reflect the value of control. But what's control? And why is it worth what it is? Hopefully you will have an answer by the end of this particular session. The last component that I want to talk about is complexity. Some companies are more difficult to value than others. And while you value them, you have to wonder whether the value should be discounted for that complexity. That's an open question. And I hope to at least lay the framework for answering that question over the course of the next few minutes. So let's see where we are. We know how to value a business now. We've got the expected cash flows, discount rates, growth rates, and terminal value. We've talked about the loose sense of how to get from the value of the business to value of equity. This session, I want to look at a specific scenario in valuation. Let's suppose you're valuing a company for an acquisition. What are some of the issues you might have to deal with? And in particular, there are 3 issues I want to address in this session. The first is I want to talk about synergy. It's a word that's often bandied about in acquisitions, and people pay huge amounts for synergy. But what is it? How much is it worth? How do you come up with the value? The second is control. In many acquisitions, you'll hear talk of a control premium, where an acquirer pays 15, 20, 25% above the market price as a control premium. What's a control premium? What's control worth? How do you value it? How do you decide whether to pay 10, 15, 30, or 50% for it? And the third, which might not always be specific to acquisitions, is what if you're acquiring or investing in a complex company, a difficult company to value? How do you bring that into your valuation? So let's start with the first issue, synergy. As I said, in many acquisitions, synergy is a word that gets thrown around often after the fact. What do I mean by after the fact? You'd see a banker value a company at 100 million. And the only way to acquire the company is to pay 150 million. So what do? They call the extra 50 million a synergy premium, in which case synergy becomes a plug variable, something you use to explain away the higher price you're going to pay. Now, when I hear the word synergy, I can attach a value to it, but I need to know what form the synergy will take. And broadly speaking, synergy can take one of 2 forms. It can be operating synergy or financial synergy. Let me take operating synergy first. Operating synergy itself can take two subforms. One is cost controls, economies of scale. By combining 2 companies, you might be able to cut costs. Why? Because you might have overlap. Those cut costs lead to higher margins, higher operating income, higher cash flows, higher value. That's the easiest synergy to value, is economies of scale. The other form of operating synergy is a little messier. These are growth synergies, and they could take multiple forms. They can take the form of higher returns you make on combined projects. So basically, synergy shows up when you have 2 companies coming together, and they can do something they could not have done individually. The combined company earns higher returns on all of its investments. It could find more investments, or it can maybe build up barriers to entry to keep the competition out, which shows up as higher excess returns for a longer period. If you see where I'm going, basically I'm looking for an input in my valuation model that I can nudge to reflect the value of synergy. It's going to show up as a higher growth or higher cash flows. They both show up as higher value. Financial synergy can take one of 3 forms. It can take the form of tax benefits. The tax code might have issues in it, or code in it that allows you to take advantage of being a combined firm. Here are a couple of examples. By combining two firms, you might actually be able to increase your depreciation charges each year. Why is that good? While that lowers your earnings, it increases your cash flows. It could also be that a portion of goodwill, that extra amount, the difference between the market value and the book value that you're allowed to book, show in your balance sheet, you might be able to write off and claim a tax deduction for it. Very unusual in the US and emerging and Europe, but in some emerging markets, you might be able to get away with that. Those are tax benefits. They increase your cash flows, increase your value. It could also show up in the form of higher debt capacity. Two companies that by themselves could not borrow much money, when they come together, might be able to borrow more. Why? Because they're larger, they're more stable. When you can borrow more, your debt ratio goes up, your cost of capital goes down because you get a tax benefit, increases your value. And there's a third potential financial benefit that's a bit controversial. Two companies come together, especially if they're in different businesses, the combined company is more diversified, right? If these two companies had been public, that's no big deal. The investors could have gotten there by themselves without paying the premium. But if the two businesses are private businesses, there is the potential for saving because there are some risks that you now are able to diversify away that hitherto were not diversifiable. So in the case of two private businesses, diversification might actually be your synergy benefit. My job when people talk about synergy is to convert talk into numbers. And here's the process I go through to value synergy. First step in the process, I value the target company standing alone, and I value the acquiring company standing alone. You cannot value synergy by just valuing the target company. You have to bring in the acquiring company into the mix. Second step in the process is I'm going to add those two values together because if there were no synergy, that's what the value of the combined company would be. Values are additive. Third step in the process is I'm going to value the combined company with all the benefits thrown in, the higher growth, the lower cost of capital, the higher debt ratio. Presumably, the value you get in step 3 of the combined company with the synergies is greater than the value that you got in step 2 by just adding up the values of the standalone companies. That difference is the value of synergy. So let me take a very simple example to illustrate this process. This was an acquisition that happened about a decade ago. The largest consumer product company in the world at that time, Procter & Gamble, bought the 5th or 6th largest consumer product company at that time, Gillette. And much of the talk around the time of the merger was about synergy. So I decided to do a best case valuation of synergy. In a minute, you're going to see why it's best case. First, I valued the two companies standing alone. I came up with a value of about $221 billion for Procter & Gamble, about $59 billion for Gillette. You add those two numbers up, you get a value of about $280 billion. If there had been no synergy, that's what the value of the combined company would have been. Then I did a best case valuation. Best case because I took everything managers told me they would do and assumed it would happen instantaneously. So they talked about cutting costs by $250 million. I assumed it would happen right away. They talked about increasing growth. I assumed it would happen tomorrow. I revalued the company with the lower costs and the higher growth rate. I got a value $17 billion higher for the combined company. That's my value of synergy. So when people tell you that finance people think that synergy is worth nothing, that's not true. Synergy is value, but here's the problem. Procter & Gamble did buy Gillette, but it paid $25 billion as a premium. If your best case valuation of synergy is $17 billion, you pay $25 billion, how are you going to win at the acquisition game? And the reason it's a best case valuation is in most mergers, it takes time for you to collect those benefits. So if you have to wait 3, 4, 5 years for the $17 billion benefit, well, guess what? It's worth only about 13 or 14 billion. So if you're going to do an acquisition and justify it based on synergy, you have to value synergy and bring it into the process and make sure you're not overpaying for it. So that's the first step in this process. Think about synergy, think about how much it's worth. Now let's talk about control. To value control, I'm going to argue that you have to do two valuations of your company. The first is a status quo valuation with the existing management running the company. And the second is a valuation of the company with you running the company. And here's why. The value of control comes from the fact that you think you can run a company better than the existing management. Put differently, if you have a company that's already perfectly managed and perfectly run, the value of control is 0. If you have a company that's badly managed and badly run, the value of control can be immense. It's the difference between two values. The value of the company run by you with better investment policy, better financing policy, better dividend policy, versus the value of the company run by the existing management. Now, of course, for you to be able to pull this off, you have to estimate what the likelihood is that you can replace the management of the company. That could range from 0, if the management is entrenched and they own all the voting shares, to 100% if the company is in play in an acquisition. But to value control, you have to do 2 valuations and assess the likelihood that you can change the way the company is run. So let me take an example to illustrate this process. Don't get too caught up in the numbers in this page. There are too many numbers. But this is a valuation I did of a Croatian tobacco company called Adris Grupa. So in the first scenario, I value the company with the existing management in place. They're not bad. They reinvest a lot. But the return on capital they make on that reinvestment is 9.5%. By itself, that's not a bad number, but that's lower than their cost of capital. They're also very, very heavily equity funded. So this management does not like to borrow money, and they're actually investing in projects that earn less than the cost of capital. I get a value for the company. That's a status quo value. I can revalue the company with somebody else running the company. Doesn't have to be me. Using a slightly higher debt ratio. I'm being realistic. I'm not asking them to borrow 90%. I'm actually just pushing them to a 10% debt ratio and actually reinvesting only in projects that earn their cost of capital. Again, I'm not asking for miracles. I'm just saying just break even. With those 2 changes, I get a new value for the company. This is my optimal value. The difference between those 2 values is my value of control. So if you talk about value of control, think about doing this for the company where the talk is around. If you get about the same value, the status quo and the optimal, there is no value of control. If you get very different values, there is a basis to the value of control. There's no easy way around this process. So now we have a status quo value and an optimal value for Adris Grupa. Here's an interesting twist. It's actually a way you can think about why voting shares often traded premiums over non-voting shares, because Adris Grupa had both of those. Here's the way I think about non-voting shares. If you get a non-voting share, you're stuck with the status quo, right? Not much you can do about changing management. So to value non-voting share, here's all I do. I take the status quo value and I divide it by the total number of shares outstanding, voting as well as non-voting, and assume that that is the value I'd pay for the non-voting share. Then I take the difference between the 2 values that I got, the optimal value and the status quo value, and assume that only voting shareholders get a share of that. It'll give you a higher value for the voting share. In this case, for Adris Grupa, you get a premium for the voting share because there's an expected value of control. That premium is going to be larger, therefore, in companies that are badly run. So if you have voting shares in a badly run company, it'll trade at a bigger premium over non-voting shares than in a company where the company is well run. That's an interesting perspective to have as you think about social media companies, where increasingly you see 2 classes of shares in almost every one of these companies. This brings me to the last issue that I want to talk about in this session, which is complexity. I've wrestled with this for a decade. So let me lay out what I'm talking about. Let's suppose you have 2 companies that look exactly the same in terms of numbers. Same profit, same return on capital, same cost of capital, same growth rate. But here's where they're different. The first company is a simple company. Simple in what sense? It's in a single business. It has a very simple holding structure, and its accounting is transparent. The second company is a complex company. It's in multiple businesses, has a complex holding structure, and its accounting is opaque. I would argue that most investors would value the simple company more highly than the complex company, because with the complex company, you're worried about what you don't know, and you know that what you don't know is more likely to contain bad news than good news. But if you want to bring complexity into valuation, you first have to measure it, right? So I'm going to give you 2 alternate measures of complexity. Here's a very simplistic one. Just count the number of pages in the 10K, the 10Q, or the annual report. I know it's simplistic, but I've found that when companies take hundreds of pages to tell you what happened during a year, that they're probably very complex companies that are difficult to value. Now, I know it's simplistic, so you can expand your definition of complexity, and I've tried on this page, and I got a little carried away, by looking at multiple questions you can ask to measure complexity. I have a complexity score. Now, you can take a look at these questions and see if they make sense to you. But what I'm trying to come up with is a score that measures how complex a company is. How am I going to use it? If I'm doing a discounted cash flow valuation, I have to bring in that complexity measure somewhere into my numbers, either into my cash flows by lowering my cash flows, into the discount rate by increasing my discount rate, into my growth rate by lowering my growth rate, or into the value of the growth by lowering the excess returns of how long this company can grow. So more complex companies for the same cash flows will have a lower value. If you're doing a relative valuation using a multiple, you might use a lower multiple of earnings or book value for companies that are more complex. In fact, as a final piece of this session, I have a regression here where I've taken price to book ratios of large market cap companies in the US. I've regressed them against the usual fundamentals, growth and return on equity, but I've thrown in a variable that you usually don't see, number of pages in the 10K. You know how you'd read that coefficient? Every 100 additional pages in your 10K knocks down your price to book ratio by about 0.3. Think about it. You're a complex company. You have hundreds and hundreds of pages in your 10K. You'll trade at a lower price to book ratio than an otherwise simpler company that looks just like you in terms of the financials. There is a price to be paid for complexity, something that companies need to factor in as they go multinational and multi-business. So in summary, if you're called in to do an acquisition, don't give up on the buzzwords. If there's synergy, value it. If there's control, put a number on it. If there's complexity, deal with it.
Oh, okay. So this video introducing the girls by the mergers, and so we do kind of these things. And so remember last video we focused on mainly on the value, the loss and in valuation, and the last video so we focus mainly on how we can do some useful things to enhance our firm value. Okay, so um, we know what we are looking for. Some things in market, uh, the only purpose is to increase the value by loss the cost of capital, increase the cash flows, uh, rise the periods, and increase more in reinvestment. Okay, you do like this kind of things. They can assure that you can add the firm value. Okay, so this is our topics in today, and so I think the is done it. So you have questions, welcome you to text me or leave your message. Okay. I'll see you next time. Bye bye.
Thank you, Professor.
Okay. Thank you, Professor. See you.
Thank you, sir.
Thank you, sir.